Yes, Mr. Furness.
Lord, I was making 5 points
Yes.
on DCC's analysis of the tax treatment of this transaction. I've made 3, and the 4th one concerns the point which my learned friend raised in criticism of Lord Justice Moses' judgment, which is elaborated at paragraph 146.2 of his printed case, page 46. Where he takes issue with Lord Justice Moses for, as he says, creating what he calls a taxable coupon of 54.8 million. That comes just by letter D on page 47. Which he says comprises £28 million for DCC and 25.8 million for X-Bank. The 25.8 million for X-Bank being, on his analysis, the amount that X-Bank would accrue in respect of the coupon. And he is saying that Lord Justice Moses' analysis in some way is open to criticism because there is this aggregated coupon which is, as he says, taxable. I'm not sure, having read this and even having heard my learned friend's submissions, where the point takes him, but in my submission the flaw in it is that there is no such thing as a taxable coupon. The learned friend explained clearly to your lordships yesterday morning that the new Schedule B Case 3 for companies taxes profits and gains of loan relationships. The old regime whereby interest and coupons were themselves directly taxable has been done away with. What is taxed is the net profit, which is the product of the Section 84 computation. And coupons may well generate sums which go into the computation, but they're not themselves taxable. So it doesn't signify from a tax point of view that a coupon is accrued to a particular party in a transaction, if that party is also entitled to accrue and claim a debit of a corresponding amount. It doesn't generate any taxable consequences in the hands of that taxpayer.
Can I ask a question which shows my complete ignorance? What precisely is a coupon?
Well, the coupon is the 6 monthly interest which is generated on a gilt. I'm not sure it isn't true now, but at one time, if you had bonds and that sort, you would have coupons which you could actually detach and present to claim the interest on the bond. So I think that is the source of the expression, but it's simply a 6 monthly payment of interest.
And it's paid gross, is that right? Without deduction of tax?
It's paid without deduction of tax, as my own friend explained, essentially for economic reasons. It was decided to abolish the withholding tax on gilts to make them more attractive to foreign investors. But we don't then see that there is any problem in Lord Justice Moses' analysis in terms of the way it works, in terms of the amount of tax it generates. What Lord Justice Moses is saying is that instead of, as he would accept, a 2.9 million accrual in respect of the coupon, that has to be increased to 28.8 million. Now, my learned friend obviously objects to that as a process of statutory construction, but at this point he's accepting that premise, that that's the right thing to do. But DCC has an equal and opposite debit under Section 97, so the coupon is cancelled out under Lord Justice Moses' approach in DCC's Section 84 tax computation, leaving just the 1.8 million interest generated under Section 730A. So there doesn't seem to be a tax problem there. It generates the result that Lord Justice Moses was looking to generate. And in the hands of X-Bank, as I explained this morning, X-Bank will be accruing the coupon. We would say it would accrue all of the coupon. My learned friend says it only accrues 25.1 million, but whichever is right, there will be some accrual for the coupon. But there will also be the deemed accrual under Section 97, which is deemed to, which is an interest payment which is deemed to arise under the loan relationship, which is the same as the gilts. But I think, my learned friend will correct me in reply if I'm wrong, I think we're both agreed that there's no double counting element there, that X-Bank will simply be taxed on 28.8 million, which is the right amount for it to be taxed on. So it's not a criticism, we say, with any point to say that somehow there's a double taxation of the coupon. It's taken into account in both DCC's computation at 28.8 million and in X-Bank's computation at 28.8 million. But DCC has the corresponding debit to net it off. And so it doesn't actually generate any tax result. I mean, one can imagine a situation in which there's more than one party through which a coupon is relayed en route to the ultimate owner. But as long as it passes through the accounts of each of the successive recipients and ends up only featuring as a positive credit, uncancelled by a debit in the hands of the ultimate recipient, there isn't, it seems to us, any criticism that can be made of Lord Justice Moses' approach, if you accept the premise that it was right to increase the accrual for the coupon to 28.8 million in the first place.
I think we had difficulty with the last sentence of subparagraph 2 of 146, where you'll see the word taxation is there. And I wrote down the words taxable amount as what Mr. Gardner was referring to, but you say, well, there isn't any taxable amount in the figure that's referred to. Do I understand you?
Well, Lord, no. I mean, all that is taxable is the net product. Clearly, the amount of the coupon and the amounts accrued in respect of it goes into the computation. But there's no harm. One coupon can go into as many tax computations as you like, as long as it's netted off by a corresponding debit. I mean, clearly, it would be a vice of any construction if both DCC and X-Bank were taxed on the coupon, because but that's not the position. And I as I say, with respect to my own friend, I don't really understand what the practical outcome of the criticism that he makes of Lord Justice Moses's judgment is in tax terms.
But just as a matter of ordinary language, it's possible to talk about an amount being taxable even though it's subject to deductions.
My Lord, you could say that it's taxable. I mean, I would quibble and say technically it's not. What is within the charge to tax is the profit of the entire computation and not the individual elements. But
Well, that's point 4.
And then point 5 concerns the accrual of 2.9 million by DCC in respect of the coupon, and it's interesting to see where this comes from, and we see where it comes from in Mr. Holgate's report at paragraph 716 and 717. That's in Appendix 2. It's page 235 of Appendix 2. Your Lordship has seen this before. Mr. Holgate offers scenario 2 at the top of the page is simply Mr. Holgate accepting the proposition, which is now accepted by DCC as well, that it isn't the case that paragraph 15 of the legislation deems them never to have owned the gilts at all. So having disposed of that, this is on what is now the agreed scenario. And 716 says, as described in paragraphs 4 and 5 of my report, the accounting treatment follows the substance of the repo arrangement rather than its legal form. Therefore, from an accounting perspective, even though DCC legally owns the gilts, as in substance it does not have beneficial ownership of the gilts, DCC does not recognise the gilts as an asset and does not recognise any income in respect of those gilts, and on this basis DCC would not recognise any profits, gains, losses or interest in the accounting period in respect of its legal ownership of the gilts. And one would have thought that that was the answer, that applying normal accountancy principles and accruals basis of accounting, having regard to the actual circumstances in which these gilts were acquired and disposed of, one would have supposed that that was the right answer, zero accrual. But for reasons which we'll consider in a moment, DCC they originally argued for that, but they've abandoned the argument in favour of zero accrual and pinned their colours entirely to the mast of accrual of 2.9 million. And that seems to go hand in hand with their complete disavowal of the relevance of any element of the statutory accounts to the exercise which is being undertaken under section 84(1). So instead of adopting the actual accounting treatment as described by Mr. Holgate in paragraph 716, DCC are arguing for a variant or a different treatment as described in 717, which is posited on the assumption that we ignore the debits and credits arising on the acquisition and disposal of the gilts with Ulster Bank, but it's still necessary to account for the legal ownership of the gilts being the loan relationship. And then the position is as follows. So what he's doing here seems to be that he's completely ignoring the actual circumstances in which the gilts were acquired. And he's going on in 718 to say that obviously the gilts were not acquired from the government, but DCC held the gilts at coupon date and was entitled to receive an interest payment. From an accounting perspective, applying the accruals basis, it's appropriate to bring into account the interest accruing on gilts only in respect to the period those gilts are held by DCC, i.e. the portion of the interest received by DCC. This is because any other party holding the gilts before and after the term of the repo transaction would expect to be compensated by receiving their proportion of the coupon. And therefore, under this assumption, the sum which fairly represents the interest on the gilts held by DCC, ignoring any purchase and sale proceeds, come to that in a moment, is the accrued portion of the coupon for the period. So that's where they get 2.9 million from. But this is, to make, in our submission, a wholly artificial set of assumptions about the circumstances, or lack of circumstances, in which these gilts were acquired. We've moved away from the actual authorised accounting treatment of these gilts to a situation in which we are asked to ignore the circumstances in which they're acquired and disposed of, and just assume that they are held for so many days out of the total coupon date, and then the accrual is made in respect of that. Now, footnote 9 at the bottom of page 236 is quite interesting in this respect, because this is where Mr. Holgate explains ordinarily how you would accrue a coupon or dividend outside a repo situation, where you simply acquire gilts and then dispose of them. And he says, ordinarily, as well as any coupon or dividend, any premium or discount on the purchase and subsequent redemption of a security, if known, would be taken into account when determining the interest income in respect of that security. That interest would be accrued in the profit and loss account over the period of ownership. And he says, if any repurchase agreement was ignored, then any premium or discount would be amortized to profit and loss account, also ignored or didn't exist. And then he deals with that situation. But the ordinary position is, if you're taking account of the circumstances of the purchase and subsequent redemption or repurchase of the security, you would take into account any premium or discount on the purchase and the subsequent redemption or resale. In other words, you would look not merely at the amount of interest which is accruing, but at what you bought and paid for the security. And if you bought at 100 and sold at 101, clearly you would accrue a profit of 1. Now, that might be representative of the amount of interest that's accrued on the gilts during the period you held them, or it might not. It may be that 2 was accrued as a share of the coupon during your period of ownership, but the market in gilts has moved against you in the meanwhile, so that when you sell, you only end up making a profit of 1 and not a profit of 2. And as I understand it, what Mr. Holgate is saying in footnote 9 is that ordinarily you would book a profit of 1. Of course you would. You would adjust your income accrual to take account of the fact that the actual difference between what you buy and what you sell is less than the amount of the interest that's accrued in the interim. How could one do otherwise? That logically has to be the only profit you've made. So what this tells us, and Mr. Holgate is quite open about this, is that that in making this hypothesis, in order to generate 2.9 million, he's completely ignored the possibility of any discount or premium on the purchase or resale. He has simply assumed a flat accrual of interest.
Where is this point taking us?
Well, look, where it's taking us is this. It's illustrative of DCC's insistence that we pay no attention to the actual accounting treatment of any of these transactions. Here we are asking Mr. Holgate to make these assumptions about or disregard, if you like, the actual circumstances of the acquisition and disposal of the gilts, and simply accrue interest on this disembodied holding for that period. Now, your lordships may remember the question, the confusing question which my learned friend referred to yesterday, which Lord Justice Ricks refers to in his judgment. And that question, or perhaps it would be sensible to look at it. It's page 416 of Appendix 2. Your lordships will see what actually happened was that Mr. Holgate produced a report, and the revenue, accepting that he was an acknowledged expert, I mean pretty well as eminent an expert as you would find in the field, and seeing that it was a perfectly straightforward and honest and down-the-line report, decided they weren't going to call their own expert evidence, that they would accept Mr. Holgate's evidence, but we asked some clarificatory questions arising under his report. And this document represents Mr. Holgate's answers to those questions, which were given before the hearing, before the Special Commissioner started. The question which we're looking at on page 416 is, what is the correct accounting treatment for the following transaction? Company A purchased gilts for X pounds, held it for 7 days, receiving a coupon of 28 million, and then resold it for X pounds. So you're here assuming that you buy and sell for the same price, but you receive the coupon in the interim period. And the significance of the question was just to tease out the fact that depending on what assumptions you make about what you buy, and the price at which you buy and the price at which you sell, the rate of accrual will change. And you could make any assumptions between the two. And where it gets us is this, that Mr. Holgate can justify his 2.9 million only on the basis that he simply ignores the possibility or doesn't pay any attention to the actual circumstances in which these gilts are acquired and disposed of.
And is that the same true for Mr. Justice Norris accepted the 2.9
Yes.
accruals, and so did Lord Justice Moses?
Well, they did, yes.
And was it based on that same assumption?
It was based on that. It was based on the assumption given by that we've just looked at in paragraph 717 of Mr. Holgate's report. But what is striking is that even in respect, as I've made this point before, but I'll make it once more, even in respect of the real loan relationship, DCC are not prepared for the court in performing an exercise under Section 84, to look at the actual reality of the circumstances in which those gilts were acquired and resold. The actual reality was they were acquired and resold under a repo, and therefore conventional accounting, normal accounting principles would simply ignore the coupon altogether. But rather than accept that reality, DCC asked Mr. Holgate to assume that he has to ignore the fact that the gilts have been acquired and disposed of under a repo, make no assumptions at all about the circumstances of acquisition and disposal, and simply time accrue the interest. Now, of course, I accept that Mr. Holgate's evidence on the basis of the accruals is correct. I'm not in a position to dispute that. But what we take issue with is the assumption that he's being asked to make. Now, it's worth just, in my submission, spending a little time thinking about the implications of DCC's insistence that the amount of interest accrued is 2.9 million rather than nil.
Could I, it's really going back to your fourth point, ask a really elementary question. If one company sells gilts and another company buys the gilts halfway through a coupon period, what in practice happens? You pay for the accruing interest now, do you, in an ordinary stock exchange transaction?
I believe so, Lord. The price of the gilts in the market would reflect the fact that you had bought 3 months' worth of interest.
And is part of the price that the purchaser pays a manufactured dividend then?
Not necessarily, my lord. You can simply sell your gilts on the basis that in 3 months' time, that 3 months' interest is accrued, and the purchaser will benefit from that in 3 months' time, and he can simply pay you now the value of that rolled up interest, and then take it all for himself when the coupon period arrives.
So an element in the price that the seller receives is really attributable to the part of the coupon which he doesn't actually get, but is a sort of interest element on the basic sum. Is that right?
My lord, yes. And under loan relationships, your lordships may recall that there are these things called related transactions. If we look at section 84.4, sorry, I beg your pardon, 84.5 and 84.1. Actually, we need to look at the full text.
Yes.
If your lordships can look at Authorities Bundle 1, rather than my learned friend's abbreviated version. Um, 84.1 requires a computation which of the sums which, in accordance with the authorised accounting method, would take together fairly represent for that the accounting period in question profits, gains and losses of the company and interest under the company's loan relationships. It's profits, gains and losses of the company, including those of a capital nature, which, disregarding interest and any charge or expenses, arise to the company from its loan relationships and related transactions, and interest under the company's loan relationships and all charges and expenses incurred by the company under or for the purpose of its loan relationship and related transactions. And related transactions are defined in 84.5 in relation to a loan relationship means any disposal or acquisition in whole or in part of rights or liabilities under that relationship. So the purchase of gilts and the onward sale of gilts are related transactions in respect of those particular gilts. Now, as my learned friend explained yesterday, in the context of a repo, we're not interested in related transactions because paragraph 15 says that where you have a repo, the acquisition and disposal are not to be treated as related transactions.
Yes. So one reads subsection 5 with paragraph 15 of Schedule 9.
My lord, indeed. So in the case of a repo, there are no related transactions, and your lordship can see why, because if paragraph 15 didn't disapply the related transactions provision, we'd have another, not three debits and credits, which is bad enough, but another one arising on the on the differential between the purchase price and the acquisition price, which would complicate things beyond redemption, and certainly beyond what was at all necessary. Essentially, Section 730A captures the whole of the profit on the repo. You don't want also to have to worry about the profit on the difference between the purchase and the sale price. So that's why related transactions are knocked out in relation to repos. But coming back to Lord Walker's example of selling gilts.
If I could just,
Yeah.
what I really want to know is when the 6-month instalment of interest is paid to the purchaser, what does the purchaser pay tax on? Is it the 6 months or the 3 months?
He would pay tax on the 3 months, my lord.
Because it's an accruals basis.
Because it's an accruals basis, my lord, yes.
That would be a simple application of 84.1, would it?
It will be a straightforward application of 84.
Yes,
yes.
Yeah.
Yes. But I mean, looking at the position of the vendor in that transaction, the person who sells after 3 months. I mean, supposing that he bought after 1 month and sold 3 months into the period, he would have he would have related transactions, being the acquisition and the disposal of the gilts, and one would expect he would make a profit on that because the gilts will have gone up in price during that period. So he will make a profit on the difference between the acquisition cost and the disposal price. And that may or may not reflect the amount of the interest which is actually accrued. I mean, the amount of interest, it will reflect the amount of interest that's accrued, but it may not equal the amount of interest which is accrued, because, as your Lordship will well understand, the gilts market can move up and down by reference to changes in interest rates or even apprehensions about future changes in interest rates. So it's entirely possible that the profit that you make on your related transactions isn't quite the same as the amount of interest which on a time accrual basis has accrued.
Forgive me,
during
you
your period
keep
of
adding these extra bits which make it more complicated. Can you give me a really simple answer? So the vendor, you say, is taxed, and he's taxed on 3 months' interest, is he, or is
Yes.
he taxed on something different?
No, he'd be taxed on 3 months' interest, my lord. Yes.
And he isn't treated as getting a manufactured dividend. He's simply treated as taxable on an accruals basis on 3 months' interest.
Lord, yes. Of course, the transaction could be structured differently. I mean, you could agree that you will buy the gilts ex-dividend, and therefore, when the dividend falls in, you will transmit it to the vendor, in which case you'll buy the gilts at a lower price, but you will not have to, you won't get the benefit of the coupon. And in that situation, of course, there would be a manufactured payment. It depends, really, on the terms on which you choose to buy your gilts.
Thank you.
Is that making sense? I'm not sure whether I can help your Lordship any further on that. But, I mean, the loan relationship, coming back to the loan relationship treatment of those transactions, if you buy after 1 month and sell after 3 months, I say you will have a profit on your related transactions, which you will bring into your Section 84 computation as a credit, assuming you've made a profit. But you wouldn't also accrue the interest, because the whole of your profit on your holding of gilts for 2 months is captured by that difference between the two transactions. So once you look realistically at what has happened, the purchase and the sale and the profit, the application of an approach of taking together and fairly representing would absolutely rule out the possibility of accruing interest as well, because if you have regard to the true circumstances of acquisition and disposal, you don't need to do that. And the same is true here. That if you actually have regard to the actual circumstances in which these gilts are required, there's no need to accrue the interest, because normal accounting principles will tell you that they're to be regarded as beneficially remaining in the ownership of X Bank. But this argument of DCC is that you have to accrue interest simply because they've owned the gilts for 15 days and therefore you accrue 15 days worth of interest, or whatever the period may be. it does have wider pernicious effects because this argument also applies in any situation where you have a repo of gilts, even where you're not crossing a coupon date. So you have my example of the taxpayer sorry, not my example, but you have the situation where the repo occurs in month 2 to 3 of a coupon period. There is therefore no receipt of a coupon, no complication of manufactured payments, but there's nonetheless a repo. And as we understand DCC's argument, they would say that in that situation as well, the interim holder, the DCC company, has to accrue part of the coupon in respect of its period of ownership.
Well, I understood that to be the requirement of Section 84(1), according to Mr. Gardner. I mean, the whole point is he takes us back, as we saw earlier, to the accruals method as the appropriate method for dealing with these things.
Yes.
And he says, I'm simply applying what the statute tells me to do.
But, well, indeed, then I'm at the moment, that is indeed his argument, and I'm exploring, as it were, the implications of that. And the consequence outside the sort of transaction we're dealing with here, where the repo spans the coupon date, is that the company in DCC's position will end up not making an artificial loss, but making an artificial profit, because it will be taxed both on the interest which arises under 730A, which is the profit on the repo, and also on an accrued portion of the coupon. Now, the revenue have never sought to tax anybody on that basis, and unsurprisingly, nobody has ever offered to have themselves taxed on that basis. It's never been an issue. But one can imagine a taxpayer's response were the revenue ever to attempt to do that. And the taxpayer would say, well, this is wholly artificial. Look at my accounts. Authorised accounting method shows that this repo generated a profit of 1.8 million, or whatever it is, and nothing else. How can you say that applying an authorised accounting method and taking together you can justify also accruing to me part of the interest on the gilts, which I've never actually become entitled to? The taxpayer in that situation will quite rightly say, you cannot say that the legislation compels that conclusion. You have to take the legislation with a dose of reality. Your Lordship can imagine my learned friend making those submissions, I'm sure. And they would be extremely difficult for the revenue to answer. To say that this legislation was actually in some way designed to tax taxpayers on accruals of coupon to which they were never actually entitled, and on which on no authorised accruals basis of accounting would they ever have accrued to them. All the revenue could say is, well, you have to disregard the actual fact that this is a repo, ignore the circumstances in which you acquired and disposed of it, and accrue some interest in the abstract. But if that argument, if the 2.9 argument is wrong, that you have to look at the underlying reality of what is going on, then that affords powerful support for our general argument that that's also true in respect of the deemed transactions as well. Because really the rationale for not accruing any interest in respect of the coupon is that 730A has already brought into account the appropriate amount of interest profit on this transaction. So what we say is that DCC's insistence on getting away from the statutory accounts completely and retreating into an area in which no element of reality is allowed to filter through, either for the real or the deemed loan relationship, is not one which can sensibly be fitted in with the requirement of Section 84, that you take your sums together and see whether or not they fairly represent together the interest or the profits and gains, as the case may be, on the loan relationships.
What role does the 2.9 play in DCC's argument? Is it simply because it deducted that from the total coupon to achieve the loss?
Lord, no. I mean, it's only. Here am I saying that the proper deduction should be zero. I mean, that will obviously increase the amount of their loss if I'm otherwise unsuccessful.
But it's not an essential part of their argument, is it?
It's not an essential part of their argument. I mean, they used to argue, first and foremost, that the deduction was nil. They've moved away from that. All I'm saying is that if the 2.9 accrual is useful to them, because it fits in entirely with their approach of compartmentalising each of the three loan relationships and at all costs not putting them together. And if you're going to take that approach, where you end up with, logically, is saying it's 2.9 million.
I think all what's happening, if I understand it, is set out in the notes to section 84 in the document we were given this morning. And what he's really saying is, well, I've got to do something with each of the fictional loan relationships.
Yes.
And I can't ignore this. I mean, I have to look at them all, and it may be rather untidy to create this 2.9 million, but there it is. It's a product of looking at that particular part of the transaction, and therefore it has to go in, and it's set off in part against the debit of 28.8. So it doesn't. I don't think it goes to the root of Mr. Gardner's argument. It's just simply that he says, well, he's following through the statutory instructions, and you just have to build this little bit into the overall computation.
Well, yes, it is, as he says, the consequence of his argument that if you're going to look at each one individually, then you have to do something for each one.
Right.
And if you're going to isolate the holding of the gilts in this way, then you end up with 2.9 million.
Yes.
But that's, we say, a powerful argument for saying that the underlying basis of that approach is misconceived, that you don't look at them individually, you look at them together. Now, Lord, to move on to a distinct point, we have a section in our printed case on authorities on the construction of tax statutes and the need to avoid, where possible, absurdity and so on and so forth, which Lord Justice Moses said we trotted round the paddock.
Are you going to do that?
Sorry, I'm not going to do. Well, I'm sure that as former standing counsel of revenue, he's probably trotted them round the paddock often enough to be heartily sick of them. Your Lordships don't need a tutorial for me on statutory construction, as Lord Clerk pithily observed from my learned friend yesterday. The bottom line is it's the same for revenue statutes as for all other statutes. Paragraph 54 onwards in our case is where we set this out. 52 onwards. And I'm not going to ask your Lordships to read that now. I'm sure your Lordships have got the basic message.
I wasn't sure whether Lord Justice Moses thought a hobby horse was a good thing or a bad thing. Anyway.
If your Lordships want a useful summary of some of the key quotations, we refer to, at the bottom of page 26 of our case, we refer to Jenks and Dickinson, which is a first instance decision, but it is a decision of Lord Newburgh, as he now is. And from page 870 onwards, there is actually quite a helpful collation made up by, not by me, but by Lord Newburgh of the relevant authorities. And if your Lordship wants to find, Lordships want to find an assemblage of quotations, that's as good a place to look as any. The one point that I would draw to your Lordship's attention is the passage that we quote from Marshall and Carr in paragraph 54 of our case, which deals with the application of deeming provisions. My learned friend refers to this as my favourite case, and it's true that it seems to find its way into every argument that I put up against it, but simply because deeming provisions nowadays are ubiquitous in tax legislation, and one always seems to end up construing a deeming provision, and quite a lot of the time they are the source of the problem, whatever it may be. Because although they are immensely useful and powerful tools for draftsmen to deploy, they can sometimes go wrong and have unintended consequences. And your Lordship will see what Mr. Justice Peter Gibson, sitting in the Court of Appeal, said in Marshall and Kyle, and this passage was approved by the House of Lords when they actually reversed the Court of Appeal on other grounds, but this passage was specifically approved, and it does seem to have become the accepted proper approach to the construction of deeming provisions. So he says, you give the words use their ordinary and natural meaning, consistent so far as possible with the policy of the Act and the purposes of the provision so far as such policy and purposes can be ascertained. But if such construction would lead to injustice or absurdity, the application of statutory fiction should be limited to the extent needed to avoid such injustice or absurdity, unless such application would clearly be within the purposes of the fiction. And then he goes on to say that because one must treat as real that which is only deemed to be so, one must treat as real the consequences and incidents inevitably flowing from or accompanying that deemed state of affairs, unless prohibited from doing so. So I think, were he to deploy this passage, my learned friend will probably take comfort from the final words. He would say, well, you have these deemed loan relationships, you just have to take them. If the statute says that DCC has a loan relationship under Section 97, then you have to assume that there is a genuine loan and that it has a life of its own, as it were, disassociated from the manufactured payment, which is the underlying genesis of the deemed manufactured interest. But we stress the earlier part of that passage which we've underlined, which is, we submit that DCC are pushing, particularly the deeming provision in Section 97, further than it will bear, because they are pushing it to the extent of saying that this is a wholly independent loan relationship that you have to adjudicate on and give an accruals basis sum for, without any regard to its part in the overall scheme of the repo transaction, without any regard to its part in the as one of three loan relationships derived from a single transaction. We say that is the approach that leads to absurdity. It's this compartmentalisation, particularly of Section 97 and Section 730A, the two deeming provisions, and leaving them to stand alone, as opposed to saying, well, really the function of the deeming provision is to create deemed interest for the purpose of bringing it into the calculation, but that you're not, when then deciding how to quantify that deemed interest, what sum to take into account, either as a credit or a debit, you're not then precluded from looking at the underlying reality which gave rise to the deeming in the first place. Because if you don't do that, if you look at them as entirely separate and self-contained, then you end up with the unjust and absurd result, which DCC are contending for in this case.
I'm not quite sure that that's really the Marshall and Kerr point. Because Mr. Gardner will say, well, very well, I press the deeming provision no further than it has to go, but look at 97(2)A. I've done no more than it requires. I've got a debit there, and there it is. Whereas what you seem to be doing is reading in something that isn't there, not in 97 anyway. Yeah. You're introducing an additional element, which Mr. Gardner says, well, where is the authority for that? And we always come back, I think, to your construction of 84.1. Yeah. So it's not really part of the deeming bit, except you say that the deeming provision has to be seen for what it is. Yeah. It's a deeming provision.
It comes to no more than that.
But, yes. And you can't really criticise Mr. Gardner's application of the provision, but as far as he takes it on getting his debit. Yes. But you're saying, well, if that's what the deeming provision does, you have to assume something else, which is the product of 84.1.
Yes, yes. Well, your Lordship is right, that it always comes back to 84.1 rather than rather than section 97. I would accept that, yes. That's all.
Would you not say, could you say that Mr. Gardner is trying to read into his freestanding and disembodied loan relationship identified in 97.2a, that it's a loan relationship which lasted only for 18 days?
Well, my lord, he is doing that. As I submitted before the Short Adjournment, he has to, or Mr. Holgate on his behalf, has to make some assumptions which are not in the statute.
Indeed, Mr. Holgate does specifically, expressly make that, refer to that as an assumption in his report.
Yes. Well, my lord, that's true. But once one is in got to the position of saying, well, we have to make assumptions, then it's hard to know which assumptions to choose. I mean, we're saying, well, you shouldn't have to make assumptions at all if you look at the underlying reality. Any accountant will have no difficulty in telling you what this sum should be. Lord, I then wanted to move on and look at the judgments below. First of all, the two in Learned Friend's favour, and then, in particular, the two Court of Appeal decisions in our favour. I'll say a little bit about the Special Commissioner's decision, but with all due respect to him, I think the argument has moved on a bit since his decision. And perhaps I might start with Mr. Justice Norris, because as your Lordships will have seen, his judgment is significantly more detailed in its exposition than Lord Justice Rymer's. I hope it's fair to say of Lord Justice Rymer that essentially he expresses the similar reasoning in more compressed form, but one sees the full exposition of what seems to underlie both judgments very clearly in Mr. Justice Norris's judgment. So that's it's in the core bundle. It's in part 1 of the appendix.
Page 78.
It's page 78 of part 1, Lord, yes. And I was going to jump straight to the analysis and reasoning, which really starts from paragraph 41 or 42. 41. He summarises the judgment below of the Special Commissioner and says that in 41 he thinks he's wrong, and says, I'll give my reasons and address various arguments advanced by each party. Particular steps in the analysis must be wrong. And I just want to pick up, as Merlin Friend did with the judgment, one or two points. Obviously your Lordships will have read or will read the judgment in full. Paragraph 42, my starting point is the terms of the statutory provisions themselves, without any presupposition there to be read as charging the economic profit to tax. Taxing provisions are not necessarily aimed at economic profit. Well, of course, that's perfectly true. There are some tax provisions which pay little or no attention to economic reality. But what we would say is that these provisions, particularly section 84, talking about the need to make sure that your sums taken together fairly represent profits, gains and losses and interest, are more obviously aimed at least attempting to tax an economic profit than most tax provisions are. I mean, the use of authorised accounting methods and the criterion of a fair representation looks like legislation, which at first blush is aiming at taxing the economic profit. Of course, it may fail to do that, but it's, in our submission, not an unwarranted presupposition in this case to suppose that Parliament believed that loan relationships would be taxed by reference to their economic substance rather than on some other completely arbitrary basis. Paragraph 43 he refers to he looks at the loan relationships which are in contention here. And he says, with reference to the gilts, this is below H and J, he says section 84 in the accruals method is concerned with the allocation of income to different periods of account rather than the admission or elimination of entries in the account, DCC actually received 28.8 million as a profit or gain arising from the loan relationship constituted by the gilt. What sum under the accruals method fairly represents that, in my judgment, 2.9 million. So that's where he deals with the accrual of 2.9 million. And he says at the bottom of the page, very last line, this was in fact the evidence of Mr. Holgate in paragraph 719 of his report. Well, yes, it was, but that was evidence given on particular suppositions about the need to ignore the circumstances of the acquisition and disposal of the gilts. But the judge doesn't really address whether or not that supposition is correct. And he seems to pay no attention, as under that supposition Mr. Holgate pays no attention to the actual circumstances under which the gilts were acquired and disposed of. And it's also interesting in passing, this is the point that emerges from his judgment a little later on, is that he says that the accruals method is concerned with the allocation of income to different periods of account rather than the admission or elimination of entries in the account. Now, as I pointed out to your Lordship this morning, Section 85 defines an authorised method of accounting as one that respects normal accountancy principles. And Mr. Holgate's evidence, for example, on FRS 5 and application note B, shows that in the context of gilts acquired under a repo, normal accountancy principles are very much about deciding whether or not to accrue interest. They're not simply about allocating between one period and another, because under FRS 5 and application note B, an accountant would say, applying normal accountancy methods, that nothing should be accrued in respect of this coupon. And then we come over on page 44.
Paragraph 44.
Sorry, paragraph 44, I beg your pardon, rather than page 44, I'm sorry, my Lord. He then goes on to talk about the Section 730A loan relationship, and he describes how that works. And then just below letter C, he says, these provisions do not, quote, unquote, recharacterise the coupon. They create a fictional sum, the deemed manufactured interest, numerically equivalent to but different from the coupon, and quite possibly payable at a different time. Because the repurchase price is thus adjusted by the amount of the deemed manufactured interest, the deemed loan is won by DCC to X Bank amount equal to the sale price of the gilts, and the differential is £1.8 million. Now, again, he looks at that £1.8 million as it were entirely in isolation. There's no suggestion here or elsewhere in the judgment that he then links that to the, places any significance to the fact that the 730A interest is in fact representative of the profit on the repo.
Aren't you jumping a bit fast in saying that it's entirely in isolation? Because obviously he has to identify the various elements, and that's what he's doing so far.
All right, well,
I think we probably, you may be right, but one would find it later.
We'll read on. I mean, what he does is to reach his conclusion, which he does in paragraph 49, where he does his sums, your Lordship sees the computation. And up to that point, he hasn't really looked at the revenues argument at all. Then it's fair to say he then deals with the revenue argument and rejects it later on in paragraph 55 of his judgment.
Which do you say are the key errors then in these paragraphs?
Well, the key errors are the page 134 down to paragraph 49, where he does his sums in paragraph 49. Pay no attention to, we say, to the need to take the three interests of the three loan relationships together and see what sums fairly represent them as taken together. So he manages to reach the result which DCC are contending for. but only at the expense, we say, of not carrying out that exercise. And then we take issue with him, really fundamentally, in his conclusion in paragraph 55, where he considers our arguments on taken together fairly represents. My argument
Can
is...
I just interrupt you, because it's quite important to see just what he's done so far at
Yes.
49, because I'm looking for a reference to section 84.1.
Yes.
And I think I find it at paragraph 43, letter H. Is he
Yes.
construing section 84.1 correctly in that sentence?
Well, he's essentially paraphrasing it. So I think one has to say that he's must identify it according to the accruals method, and when taken together with any other credits that is produced by the accruals method, fairly represent. Well, the only sense in which he's not paraphrasing section 84 is that he talks about the accruals method rather than the authorised method of accounting. The two are, in this case, synonymous, because accruals method, we're agreed, is
Yes.
the authorised method. But there is, in the judgment, no recognition that normal accounting principles have any part to play in the accruals method. He's saying throughout that accruals is simply about allocating income to periods. And the passage I just showed you, where he said it's not about deciding whether or not to accrue something at all. So we say he takes a rather too narrow view of what the accruals method is really about. And paragraph 52, for example, is a passage which a learned friend quotes in, I think, paragraph 160 of his skeleton. He says, it's the passage, I think, at letter F on page 135. In my judgment, the reference to authorised accounting methods is a reference to the method by which particular sums are brought into account in each accounting period. It is not a reference to authorised accounting methods generally or to normal accountancy practice generally. But your lordships will recall that an authorised accounting method must respect normal principles of accountancy. It is a bit wider than just saying which period do you allocate interest to. I mean, it is, for example, to do with deciding whether or not to accrue anything at all, for example, in the case of gilts that are held under a repo.
It's just that that bit, particularly the passage in parenthesis at page 89, letter H.
Yes.
He's saying when taken together with any other credits and debits. But your point, I thought, was that they have to be taken together with each other.
Well, Lord,
And
that's right.
He doesn't actually say that. There may be a bit of a quibble, but...
well, my Lord, yes, it's clearly intended to be a paraphrase of what Section 84 is saying, but it may be that the way it is phrased, and although it's broadly accurate, I accept your point, the way it is phrased perhaps gives some clues to the nature of the exercise that Mr. Justice Morris, accepting my learned friend's submissions, thinks that he's engaged in. And in particular, there's no recognition of the fact that in deciding what sums to take into account as credits and debits, there's no recognition of what we say is the position, namely that you have to look at the outcome from a point of view of fair representation, as well as as looking at the individual components. That there is a sort of dialogue between what goes in and what comes and the end result.
The use of the word other is probably an error.
It's either, well, Lord, it may be an error, it may be an unintentional in the sense that he didn't necessarily mean too much to be read into it.
Right.
It is, as I say, only intended to be a rough paraphrase.
Yes,
And for my part, I'm not holding the judge too closely to the words he chose to use. But as I'm saying to your lordship, that in a sense the key disagreement comes in paragraph 55, where he comes on to look at the at a summary of our argument at paragraph 54, the he at the beginning of paragraph 54 is me. And this is where the taken together fairly represents argument is
I see, yes.
is summarised. And then at 55 he says, I do not agree. What section 84 requires is that debits and credits be brought into account of those which are in accordance with an authorised accounting method, and further that the debits and credits so identified shall fairly represent the gains arising from the loan relationships. So he's there identifying, as it were, two elements to the test, a bit like Lord Justice Moses, although with an opposite result. The section does not say the debits and credits must fairly represent the profits, and it does not say you can create debits or credits such as would not normally be made in accordance with an authorised accounting method in order to produce such a fair representation. I agree with Mr. Gardner that Section 84 does not introduce some free-floating concept of fairness by which reference to tax charge is made. And then learned friend Mr. Gardner refers to the Odeon Associated Theatres case, which is in the bundle. I think it referred to in his case, although he didn't take your lordships to it in argument, which essentially says that when computing profits, generally, that it's not for the court to substitute its view for as to what is the right thing to do for those of accountants, except where there's a clear statutory requirement to do so.
Why does the judge distinguish in 55, the second sentence, between gains and profits? I mean, in fact, for what it's worth, profits and gains are both referred to in section 84.1.
So your lordship is looking where in 55?
Paragraph 55 of Mr. Justice Norris,
Yes.
just under D. Section doesn't say the debits and credits must fairly represent the profits.
No.
I don't see what point he's making there.
No, my lord, except maybe to say that, well, it does say they must fairly represent profits.
It does, and I mean, quite often the taxing statutes talk about profits and gains without saying exactly what the difference between them is. And
if I may offer a suggestion as to what the judge is driving at there, he means accounting, the profits in the accounts, I think, is probably what he means. So he's saying that there's no requirement that debits and credits must fairly represent the accounting profit. Yeah.
But the emphasis, perhaps, in that sentence is really on the word create. And that's raising the question as to what authority there
Yes.
really is for,
Yes.
for finding a credit item.
Yes. And if you accept our view of what Section 84 requires, then you will find that authority. But if you take a more limited view of what it requires, then you won't. And it's clearly, at the end of the day, a matter of impression as to what exercise you think that Section 84 is engaged
I mean, it's all down to that, is it? I mean, if we don't go along with your analysis that one should look at the thing altogether, then Mr. Gardner's analysis is perfectly good. Is it? You haven't got an alternative, have you? Quite.
Well, I mean,
we
have a couple of fallback arguments.
Yes.
Which I'll come to in a moment.
But on this part of the argument,
on this part of the argument, there is clearly a choice to be made about what you think Parliament intends.
and it's a pretty broad choice, isn't it? Because if you're still putting your argument as it's explained in paragraph 54, then the only question you have to ask is what the net profit on the whole thing was, because you're more or less assuming that all the other credits and debits will be evened out.
Well, I think that in relation to
So
three...
there's only one exercise. You're only doing the section 730A exercise, because in this class of case, you are simply assuming that the other profits and credits and debits will be cancelled out. Hence your plus 28.8 million is there in order to cancel out the minus 28.8.
Yeah.
Or is it the plus? I can't remember. But
it's a plus to cancel out the minus.
Yeah.
Yes. That's so, my lord. I mean, I have to accept the justice of that
I'm
point.
not saying it's necessarily
but,
wrong.
But it's, I would say that it's not that one should not be surprised that the intended outcome of Section 84 should correspond to the economic profit as shown in the accounts, having regard to the fact that Section 84 takes the trouble to engage authorised accounting methods by reference to the authorised accounting methods used in the accounts, and takes the trouble to say that you must take your debits and credits together to see what they fairly represent. It seems a pretty clear steer on Parliament's part that they are expecting that you will end up with the same result as the accounts, because that's exactly what the accounts are doing. The accounts are also looking at these transactions in the round, looking at their economic consequences and deciding whether or not they give a true and fair view or what they fairly represent. So the accounting exercise and the Section 84 exercise seem pretty clearly aimed at the same purpose. And
does the analysis which leads to the 1.8 million, does that apply the accrual accounting method?
The 1.8 million, my lord, well, Section 730A says that you have to apply accruals to that interest. In our case, because the repo is all the repos are within one accounting period, there's no question of having to accrue that interest between different periods. So it's not noticeable, as it were, that the accruals basis is being applied to
but
Section
it might
730.
do, depending on the
It could be. If the accrual actually spanned an accounting period, so you had to say this year's accounts I'm going to take X days and this year's accounts I'm going to take Y days, then it would be obvious that you'd apply an accruals basis, yes.
But this is distinct from the coupon element, which does have to be subject to accrual.
Well, the coupon element has to be subject to accrual as well. I mean, they all have to be subject to an accruals basis.
And then he comes down in the last two sentences to what seems to be the crucial point, that he can find, applying the accruals basis of a figure of 2.9 million, but he can't find on any approved accounting method a figure of 28.8.
Lord, that's so. And the justification for 28.8 is that if you take the three sums together, the approved accounting method says that essentially the coupon and the onward transmission are to be disregarded. If the statute is telling you have to have a £28.8 million deduction for the onward payment, for the manufactured payment, then to respect the authorised accounting treatment of the three transactions when taken together, you have to have a credit of 28.8. Yeah.
And that really is a critical paragraph.
That's a critical paragraph, my lord. We reject the idea that we're looking at some theoretical basis of fairness, which isn't anchored in accounting practice, for the reasons I gave to your lordship this morning. And I agree with my learned friend that it would be extremely difficult to justify our case if that's what we were trying to do. But we are in fact anchoring our interpretation of fairly represents by reference to normal accounting principles.
And he's left that out in his recitation of your argument in paragraph 54.
He has, my lord. I'm just trying to remember how far that point was actually developed by us before the judge, and whether or not it was my fault that the point wasn't put sufficiently forcefully to him, or whether or not he simply ignored it. I can't now remember, but he doesn't record it at that stage.
Is it sort of built into the last sentence of paragraph 54? It's fairly terse. In your explanation of section 84 to us, do you see that?
Sorry, I've lost the page.
Page 92.
Thank you, my lord. Yes, I'm sorry. Yes.
It's the words then section 84 required there to be a credit.
Yes. But it's fair to say that we have always eschewed. I mean, the learned friend has consistently accused us of relying on some abstract concept of fairness, and we have always said that that's not what we're doing. So that's a battle line that has been drawn from right from the outset of this case.
Well, is that Mr. Justice Norris? And do we go to Lord Justice Rymer?
Lord Justice Rymer next, Lord, yes. And here the key paragraph is probably paragraph 85. Where he explains that he would like to be able to agree with Lord Justice Moses, since it enables the result of the cause of conventional accounting treatment of the repo transaction and clothes the relevant legislation with a garb of commercial sanity. But then he says that he's unable to do so. And he says that Lord Justice Moses' reasoning appears to me to load onto the emphasised words, and those are the words in italics at the bottom of the previous paragraph, when taken, the key words, when taken together, fairly represent. Lord Justice Moses' reasoning appears to me to load onto the emphasised words a function which they cannot naturally bear and whose effect is promptly to derive the opening provisions of the subsection of virtually all sense. I am not persuaded the emphasised words are capable of doing the service he derives from them. As Lord Justice Moses has indicated, even DCC's case, they serve an important function, but the extent of their reach cannot, in my judgment, be such as to wholly negative the subsection's requirement that inter alia the credit interest under the gilt-loan relationship must be calculated in accordance with an authorised accounting method and brought into account accordingly. So again, it's very much Mr. Justice Norris's approach. I mean, he's essentially agreeing with him and perhaps rather more shortly summarising there the same problem which he identifies as Mr. Justice Norris identifies, which is where is the authority for bringing into account the 28.8 if there is no authorised accruals basis of accounting that will justify that sum, then how do you justify it? And he has the problem he identifies is he's saying, well, what does it mean to compute your sums in accordance with an authorised accounting method if at the end of the day you're going to put in a sum which isn't authorised in order to get a result that is authorised? And it comes back to the question, to the way of looking at it, which we prefer, which is that, and which we think is the right way of looking at section 84, which is that you have to have regard to the end result as well as the composite factors. I mean, one can only go over the point so many times.
Is there a misprint at the end of 84 before the italicised phrase all interest under the company's loan relationships? I thought that was little b of...
It is, Lord, with respect, you're quite right, yes.
But then the next question is, why is he emphasising those words? Is he saying that what you're seeking to find as a credit item is not something which fairly represents the interest? I don't quite follow why he's got that in.
Well, yes, I mean, he's here referring to Lord Justice Moses' explanation as to why...
Yes, I see. Yes, sorry, it's a quotation.
It's a quotation. And he's saying this is what Lord Justice Moses relies upon, and then he's saying in the next paragraph that I'm afraid I can't place the same weight on those words as he and Lord Justice he does, and indeed Lord Justice Ricks does. And he says he can't identify an interpretive route by which the absurd result contended for by DCC can be avoided. That's between G and H. So to come back to what Lord Clark was saying, like all questions of construction, it is, in the end, a question of impression. I can't say that my learned friend's arguments are wholly untenable. He's already convinced two highly regarded judges that they're right. But the fact that his interpretation produces what everybody in the Court of Appeal regarded as an absurd result ought to be an alarm bell, at the very least, to see if there isn't some better approach. And in our submission, our approach, under which you do take loan relationships together where it's appropriate to do so, and this is the crucial difference, you have regard to the underlying factors which generate the deemed interest, produces a sane result, as Lord Justice, a commercially sane result, as Lord Justice Rymer would like to find.
You both have problems.
Yeah.
Mr. Gardner has his problem with the 2.9,
Yeah.
and you have your problem with the credit.
With the credit. Well, I would say that when it comes to authorised accounting methods, really, 2.9 has no greater justification than 28.8. If you're really sticking to authorised accounting methods, the only sound sum to take in at that point is zero, actually.
Well, that would avoid his 2.9 difficulty, though, would it?
It would avoid his 2.9 difficulty, but it would make it more difficult, much more difficult for him to say that you mustn't look at the statutory accounts because they have nothing to do with this exercise.
I mean, in a way, it's all about what's meant by loan relationships, is it, here in the subsection? Because you're construing as if it read in respect of its loan relationships viewed as a whole, and
yes.
He's saying of its loan relationships viewed seriatim.
Well, that's one way of putting the difference. So, and of course, we say you have to view them together, but because that's what the section says. But
And it would mean the same whether fairly was in or not. Yeah, I suppose the advantage of fairly, from your point of view, is it suggests that one should have some regard to reality.
yes, or
because
indeed,
fairness is rather an odd concept when you're looking at some entirely hypothetical fiction.
well, quite so, my lord. It's fairly represents, so it's not, which, as I suggested to your lordship this morning, has quite clear accountancy connotations. But I'm not sure I would say we could get home if fairly represents wasn't there.
Well, it would still have to say represent or something like that.
Yes. So that's Lord Justice Rymer. And then we come to the two judges in the Court of Appeal who were in our favour, which is Lord Justice Moses and Lord Justice Ricks. Now, we summarise in our case the salient points of all of these judgments, and so I don't need to go over them in great details. But let me just start by saying something about the relationship between Lord Justice Moses and Lord Justice Ricks in terms of their judgment, because it is fair to say that there is some tension between them. They don't entirely, although they reach the same result, they don't entirely follow the same path to get there. Lord Justice Ricks adopts Lord Justice Moses' reasoning as an alternative to his own, and I think one probably should, I would submit, one probably should regard it as probably an alternative route to the same result rather than reasoning which is the same reasoning but expressed at greater length. But the fundamental basis of both judgments is anchored, as I've already submitted to your lordship, in the idea that it is permissible to look at the underlying reality of the deemed transactions. And that's really what distinguishes them from Mr. Justice Norris and Lord Justice Rymer, who felt unable to do that. So, I mean, the fundamental point which we support and take from Lord Justice Moses' judgment is the paragraphs towards the end, really 69 to 72. Which I've already referred, Your Lordships, really to these passages. This is where he says that the deemed interest under Section 97 doesn't lose its quality as representative of interest, cannot lose its essential characteristic. And then 70, where he says the resolution of the dispute comes down to whether the application of the additional distinct criterion, which requires sums taken together fairly to represent all interest, permits the amounts given in respect to coupons to be displaced by the amount which the deemed interest expense is supposed to represent. Now, a difference there between Lord Justice Moses and Lord Justice Rymer is that Lord Justice Moses first of all goes through the process of saying, well, what would I accrue in respect of each of these individually? It specifically says 2.9 million in respect of the gilts. And then says, well, even though I've reached that provisional conclusion, do I have to change it once I feed those figures into Section 84 and have to respect the taken together fairly represents requirement? So he's doing a two-stage process and modifying stage one by reference to the application of stage two, whereas, as we'll see in a moment, Lord Justice Ricks really jumps in and does it all in one process, and he expresses considerable scepticism about whether or not 2.9 million is in fact a justifiable figure anyway. It probably doesn't make very much difference which approach you take. Certainly it doesn't make any difference as far as the result is concerned. We would be inclined to agree with the learned friend that taken together fairly represents is a composite phrase, although I think we do derive a rather different lesson from that. And 71, Lord Justice Moses says that in order to allow the fairly represents criterion, as it were, to trump the authorised accounting method, says that that requires the first criterion to yield to the second. And as I said, we don't feel that one needs to be quite so clear-cut about that. And he also recognises that Section 84 does not assume any conflict between the application of authorised accounting method and the requirement of fair representation, which is true, but probably cuts both ways. In my view, if the sum to be brought into account as a credit is only 2.9 million, the effect is to alter the essential nature and function of the deemed interest expense, by which I take him to mean that it ceases to be something that cancels out the coupon and becomes something that creates an artificial loss in excess of the coupon. He says the fictional interest expense only exists by virtue of the statutory fictions. It only exists as a sum which is equal to and which cancels out the interest payable to DCC. A sum of 2.9 million for the coupons given as a credit by the accruals basis deprives the interest which DCC is deemed to have been paid of its essential nature and function. The effect of the application of the accruals basis to the coupons is to derive the deemed manufactured interest of its essential statutory function of cancelling out the credit payable to DCC. It produces a sum which, when taken together with other sums, does not cancel out the credit, but exceeds it by a substantial margin. My learned friend criticised that last sentence. It is certainly rather tersely expressed, but it seems to mean that the effect of DCC's approach is that it, i.e., the application of the accruals basis to the coupons produces a sum, 2.9 million, which when taken with the other sums, minus 28.8 and plus 1.8, does not cancel out the credit, but exceeds it. What he means is it results in an end product which exceeds by a substantial margin the credit taken for the gilts, for the coupon. But Lord Justice Moses' approach is clearly rooted in the need to ensure that Section 97 performs its proper function of cancelling out the coupon, and therefore because Lord Justice Moses has already concluded that Section 97 requires unambiguously a deduction of 28.8, he's constrained then to adjust the coupon up to 28.8 to ensure...
If he wants to get the 1.8 result.
He wants to get the 1.8 result, Lord, yes. But he is very much focusing here on the application of Section 97. My learned friend takes a point in his case about Lord Justice Moses. Well, what about the position where Section 97 isn't in play where you don't have a repo over a coupon date, it's just a repo within the coupon period. What's the position then? And the learned friend says, well, it looks as though Lord Justice Moses would accept that 2.9 million accrues as interest, but there is no deduction because the justification for increasing 2.9 million to 2.8 million from Lord Justice Moses' point of view lies solely in the existence of Section 97. Now, as we say in our case, as I've already said to your Lordship, that if that is the result that Lord Justice Moses is contending for, that's a criticism as much of my learned friend's case as it is of Lord Justice Moses, because it's his case that 2.9 million will accrue even in the absence of a manufactured payment.
It's understandable why the lack of express reference to the terms of Section 84(1) in Lord Justice Moses' judgment did give rise to concerns in the Institute, because it doesn't clearly appear that he was applying the wording of Section 84.
Yeah. Well, so, well, possibly. I mean, paragraph 72 is referring to the words of the section.
Yeah.
But he doesn't spell out, perhaps as clearly as might have been helpful had he been mindful of the Chartered Institute's concerns, he doesn't spell out that fairly represents is intended to, as we would say, essentially to mirror the true and fair
Yes,
view.
it's not just palm tree justice.
It's not just palm tree justice. Yeah. In my submission, Lord Justice Moses doesn't think it is either,
No.
but I can see that he might have made his position on that clearer than he did, and as I've already said, I think with some justice the same charge could be laid against Lord Justice Ricks. But as I've said, the Chartered Institute's concern is interesting, because they're saying, well, you know, we need to be able to rely on our statutory accounts in order to put in our tax computations. But if my learned friend is right, they have all these years been entirely wrong to do that, because their statutory accounts will produce a profit of 1.8 million, and he's saying, no, you need to accrue another 2.9 million and then take in a large loss. According to my learned friend, statutory accounts have nothing to do with the process. So we would say that provided it's understood that fairly represents must be understood in an accounting context, we're the ones who are actually championing accounting orthodoxy in the treatment of loan relationships, and not the learned friend.
Do we have the Chartered Institute's concerns in the papers we got here?
We don't.
We had them before.
Yes, we can get them from from our registry. They are available in our archive somewhere. I must say, I do actually have them, but we can certainly obtain copies of them.
I'm sure I saw them in the past. They're not in the bundles. I don't have mine.
I think we had them at the time of the application for permission.
No, I'm sure we have them. You would have seen them, I think, when at the application for permission
I think
was
we did. This was at the point of leave.
Yes, it was.
Yes. Well, we can look. I'm sure we have copies, don't we? Yes, we haven't them but we can look at them overnight.
I'm sure we can. Well, if you can provide us with copies, that would be very kind.
Oh well, we can certainly do that. Yes.
I wondered whether you support the last sentence of paragraph 71, particularly the way he seems to be approaching section 97. I think he's saying that has the statutory function of cancelling out the credit payable to DCC. Now, that may be quite a large assumption, but that seems to be what he's saying. Are you supporting that line?
Well, I would accept that that is its statutory function in the sense that that the only purpose we can see for giving a debit in section 97 is on the assumption that there is a countervailing credit which needs that debit to set it off. So that I would accept that is the statutory function which section 97 performs. I wouldn't place full weight on the statutory function of section 97 as being the key to this particular decision, because our case is that section 84 has the effect which we contend whether section 97 is in play or not.
Yeah.
The last sentence of paragraph 71 more or less repeats the last sentence of paragraph 69, although that
Yes.
it isn't necessarily the better for repetition. But that's where we get the first reference to the essential function, I think.
Yeah. Yes, my lord, yes. Let me see if there are any other points that I'm subject to your lordship's questions I wanted to draw your lordship's attention to from Lord Justice Moses.
So can we go to Lord Justice Ricks?
Lord Justice Ricks.
So Lord Justice Moses doesn't quite put it in the way you do, does he?
No, he doesn't. My lord, he doesn't quite put it in the way I do. I mean, he puts it differently in the sense that he looks at this as the two-stage process, whereas it comes to the same thing. But I think it's better. I would submit that Section 84 is better understood as a single process, and he puts a lot of emphasis on Section 90, on the particular provisions of Section 97, which, although it's justified, we put our case, as I've submitted, rather more widely. In that we would say that even absent Section 97, you still need to take a sensible and
where do you get the cancelling out idea in Section 97? Where do you get the idea of cancelling out?
Well, my lord, I think
in Section 97.
Within Section, if your lordship looks at the wording of Section 97. So it's behind tab 4 of Authorities Bundle 1. It's because 97 is brought into play where there's an amount payable by or on behalf of or to any company, and the amount, there's an amount payable by or on behalf of or to any company under contract or arrangement relating to transfer an asset relating to a loan relationship, and the amount is or when paid will fall to be treated as representative of interest under that relationship. So it applies to amounts which are treated as being representative. So amounts paid by the owner of securities which are treated as being representative of the interest arising on those securities. So ex hypothesi, you have a situation in which the taxpayer is paying something which corresponds to something he's receiving under the securities. And the evident purpose of Section 97 is to ensure that the taxpayer is neither better nor worse off as a result of that he gets a debit to match the supposed credit that's coming in the other way. And at the same time, the recipient of the manufactured payment, ex-bank in our case, is treated as receiving the amount of manufactured interest as if it had arisen under the loan relationship itself. So it's, in other words, as I said earlier, it's essentially trying to mirror the accountancy treatment of a repo in the hands of, actually it doesn't just apply to repos, but in this case it's reproducing the accounting treatment of the repo in the hands of ex-bank. So in other words, it's saying that where a coupon is paid from A to B and transmitted to C, for tax purposes, C shall be treated as receiving the coupon, and to ensure that A isn't taxed on it as well, A is given a deduction in order to allow it to set off against the coupon which it's receiving. Now, of course, the issue which has arisen in this case is that that deduction may not be necessary because maybe proper accounting treatment doesn't accrue anything for the coupon, and so the taxpayer has been given a deduction which maybe he didn't need, and that's really where the thing has gone wrong.
That raises a question as to whether that was really what it was really aimed to do, because otherwise it's creating a loss which can be brought into account in the accounts for which there's no countervailing credit, and it seems a rather generous thing to do.
Well, it's generous unless you have enough faith in Section 84 to assume that that the debits and credits will adjust themselves if it isn't necessary.
Yes, I mean, in isolation,
yeah,
it seems a remarkable act of generosity.
Yes.
And one wonders whether that really is what was intended, or it had perhaps some other purpose.
My Lord, I'm sure it wasn't intended to be an act of generosity, but I think it was intended to be an act of fairness to taxpayers. It wasn't intended that they should be able to create losses that they haven't accrued, but it should be. It clearly was intended that this debit should be available to set off against gains or interest that they may have received.
Well, Lord Justice Ricks.
Lord Justice Ricks. My learned friend criticised the opening paragraph of Lord Justice Ricks's judgment. It's paragraph 88, page 24 of Appendix 1, on the basis that he seemed to have misunderstood the accountancy, either the accountancy evidence or the legal analysis of a repo. I would submit, I mean, it's fair to say that the language is somewhat inexact, but I would submit it doesn't betray any fundamental misunderstanding of what repos are, and one would be surprised if Lord Justice Ricks did have a fundamental understanding of what repos are. The wording that's criticised is between D and E, where he says that repos are in substance secured loans provided by the buyer to the seller for a fee which reflects the applicable market interest rate and the amount lent over the period of the loan. So that's exactly what they are in substance. Although nominally the legal title to the securities passes and repasses, the beneficial interest in the securities remains in the seller. Well, legally, the beneficial interest passes as well. From an accounting point of view, which seems to be what Lord Justice Ricks has in mind, the beneficial interest is indeed treated as remaining with the seller. And since he goes on to say, since the beneficial interest remains with the seller, he's entitled to any coupon payments generated by the securities. So, I mean, Lord Justice Ricks is here talking about the accounting treatment, as explained by Mr. Holgate, of repos. I accept that he, perhaps unfortunately, gives the impression, perhaps, that he thinks this is also the legal position. But I think I would submit it would be a mistake to assume that he doesn't actually understand the legal position, because he's quite clear that these are sale and purchase transactions. In which case, of course, under a sale and purchase transaction, both the legal and beneficial title must necessarily pass to the purchaser.
Well, I hesitate to raise a further complication, but in fact, if one looks at the agreed statement of facts, I get the impression that these gilts were actually registered in the name of Northern Trust throughout all this transaction. But I don't think anything turns on that.
Yes, I'm sure you'll always be right. They were in the nominee company, so we are in fact only talking about the beneficial interest.
And Northern Trust on one day held them for the account of the bank, and on another day for the account of DCC.
I suspect that's quite a normal way of carrying out these transactions.
I'm sure it is.
Simply because it's so much easier to do with beneficial interest than registering the ownership, re-registering the ownership of the gilts all the time. Yes. So that's the opening paragraph. He then, in paragraph 94, having given a brief review of the legislation, he says in 94, these statutory provisions, although complex, are to my mind always seeking one goal, which is to reflect the substance of a functional secured loan transaction, even though that transaction appears in legal form to consist of a sale and repurchase. That's why the debit of 28.8 million is dealt with under the statute as deemed manufactured interest. It's an attempt to reproduce the commercial effect of a repo qua secured loan, even though it's in the form of a sale and repurchase transaction. Under an ordinary sale of securities, the buyer would receive any coupon payable on securities during the period of their ownership, and the value of this payment would have been reflected in the price paid by the buyer. Under a repo, however, because it's treated as a secured loan in which beneficial interest in securities is retained by the seller, the coupon payment belongs to the seller and not to the buyer. So he's reached the conclusion that the overall objective is to tax the transaction as a functional secured loan, and that obviously depends on looking not just at 730A, but also at section 97 and the deduction that of 28.8 million that gives, corresponding to the coupon. But he says at 95, at the end of the day, the critical statutory provision is section 84, which he quotes from. And he says at 97, the statutory phrase taken together fairly represent at first blush does not seem to be conducive to DCC's submission, which produces a result which is anomalous and uncommercial and may be said simply to fail fairly to represent the transaction and instead to create an uncovenanted windfall. And then he summarizes the 2 points of view. And he says, I agree with Lord Justice Moses, ultimately the assessment to be made by reference to these words has to be made by the court, not by a witness, however expert. And that, in my submission, reflects the truism that, of course, it is for the court to construe section 84. And it's not, and the court is therefore free to depart from Mr. Holgate's assessment of the way section 84 works, to the extent that Mr. Holgate is making legal assumptions in his report in order to do so. And he does so at various points, quite openly, and, as he says, of necessity. But he then rightly regards Mr. Holgate's evidence of considerable importance. And then he takes four aspects of Mr. Holgate's evidence, I think all of which your lordships have seen at one point or another being quoted from Mr. Holgate's report. The first quotation is the one at 418, where he summarises the accountancy effect of a repo, and then a passage of similar effect the second passage referred to at paragraph 101 is dealing with the importance of looking at the arrangement as a whole, and then 711, the passage I referred to this morning about the need to look at financial transactions in the real world. And then he proceeds to a conclusion in 716, which really does mirror what he's already said in 418. And then thirdly, this is the alternative hypothesis which your lordships have seen in paragraph 717, which gives rise to 2.9. And the judge rightly observes that it will be observed in this passage is between H and J. Mr. Holgate deals with the receipt of 28.8 million coupon in entire isolation from all other aspects of the transaction. For the reasons given at 94 above, I'm puzzled by Mr. Holgate's rationalisation for his figure of 2.9 million, but I put that aside. And the reference to 94 is to his understanding of the accountancy treatment of the repo as a secured loan, under which all of the coupon is accrued to X-Bank and none of it to DCC. And then we come to the question, which I've already shown you, Lordship. Now, the point of the question was, in fact, to try and, as I've already explained to your Lordships, not to talk about the statutory accounting position, but to try and tease out some of the implications of the hypothesis which Mr. Holgate adopted in the course of getting to a result of the 2.9 million accrual, and was really asking, well, if you change the assumptions you've made about purchase and resale price, don't you get to a situation in which you could, even on your assumption, accrue 28.8 million? And his answer is, yes, you could. I mean, clearly, if you acquire your gilts for X pounds, then receive a payment of 28.8 million, and then sell them on for X pounds, you would accrue a profit, interest or otherwise, of 28.8 million. And when Lord Justice Rick says in 106, what is the court to make of this equivocal evidence? It's not, in my submission, an unfair description of the evidence, because what is concerning Lord Justice Ricks is the difference between Mr. Holgate's analysis of the proper the proper accountancy treatment of the transactions, and the analysis that he gives in order to get to the result of a 2.9 million accrual. And he makes that point just below G, where he says the third answer in paragraphs 717, 718 is given on the assumption that the complete context of the transaction is eradicated and ignored, and all that is looked at in isolation is the receipt of the coupon by DCC at the time when it was the security's owner. In giving this answer, Mr. Holgate is expressly not undertaking any exercise which even purports to be dealing with matters on the basis of asking what sums taken together fairly represent all profits, gains and losses and all interest under the loan relationships. Although he speaks of his answer as being one that fairly represents the interest on the gilts held by DCC, that is not the statutory exercise which has to be performed, which has in any event been left, in my opinion, to the judge. For Mr. Holgate, he's looking at a single item in isolation. And then he says the fourth answer, which is the answer to our question, goes back to consider a particular item, but in the overall context of the repo transaction, albeit a somewhat unrealistic one. The lack of realism is adopted to emphasize the need to concentrate on the particular item in question. The answer appears to be that the coupon payment has to be regarded for accounting purposes as a credit to DCC of 28.8 million. And he goes back to the third answer, paragraph 107, that's the 2.9 million, seems to my mind to indicate it cannot be an attempt to give an answer to the statutory question, for its rationale is that any other party holding the gilts before and after the term of the repo would expect to be compensated by receiving the proportion of the coupon relating to their period of ownership of the gilts. He says, I have doubts about this, but accepting its logic, I observe that on that basis, the 2.9 million credit simply cannot live together with the 28.8 million debit, since the seller repurchaser is itself the holder of the securities before and after the period of DCC's ownership. So he's saying, well, in view of the fact that X Bank is the holder of the securities before and after the period of DCC's ownership, how can you accrue only 2.9 million and at the same time claim a debit of 28.8 million? And then the crucial reasoning. He says between C and D, the answer to the question, what is the credit to be accrued to DCC arising out of the receipt of 28.8 million coupon in the context of the repo transaction as a whole, and thus taking into account the datum debit of 28.8 million, can only be 28.8 million. Only that answer reflects the totality of the statutory material which seeks to recreate in its complex provisions the functional secured loan which the repo constitutes, and only that answer reflects the real evidence which I understand Mr. Holgate repeatedly to be giving concerning the proper accounting treatment of these matters. And only that answer gives a sensible, realistic and just result. Well, if by saying sensible, realistic and just result, he was saying that's what fairly represents is all about, then I would, with respect, disown that. But because, as I say, I'm happy to anchor fairly represents in an accountancy context. And again, if the language of the judge suggests that there is a broad judicial discretion to be deployed here, then I would respectfully disavow that. But in my submission, all that Lord Justice Ricks is saying there is that there is some merit to having a decision which is sensible, realistic and just. And then he also, as I say, adopts the reasoning of Lord Justice Moses. But Lord Justice Ricks's reasoning on its own very closely, in my submission, follows the tenor of the submissions I've been making to your lordships, that what is important is that you look at the three loan relationships together and you look at them realistically and not in isolation and in limbo. And on that basis, you get to the computation which we're submitting for.
Yes.
There are a couple of passages in the Special Commissioner's decision which I just wanted to show your lordship, which go to the question of the nature of the deeming provisions, and the fact that, as the Special Commissioner would have it, the deeming provisions characterise particular events or deemed events as interest under loan relationships under Section 97, Section 730A, but do not necessarily require you to ignore the actual economic circumstances which generated that deemed interest. Paragraph 148, this is Appendix Part 1. Paragraph 148 of the Special Commissioner's decision. Now, I'm in agreement with my learned friend that I don't follow the Special Commissioner all the way in what he's saying here, but he does actually, in my submission, get across the basic point that the deeming provisions are, as he puts it, clothing real economic consequences with the status of interest under the loan relationship provisions, in order to allow them to be brought into the computation, but that it is a process of clothing them with an attribute rather than completely denaturing them and saying that they're something completely other than what they are. So he says in paragraph 148, 97.1.3 applies in relation to gross paying repo to clothe the contractual manufactured payment with the attribute interest on a loan relationship, so as to characterise that payment as something on which Section 84 can bite. And then he says in paragraph 155 that the consequence of such characterisation is to switch on Section 84. One is required as a result to determine what sums arise as a result of the application of the authorised accounting method to the circumstances which give rise to this deemed loan relationship. What sums arise? The answer is none. Mr. Holgate's evidence was clear. Neither the receipt of the actual coupon nor its onward payment in the case of a gross paying repo, nor its economic application to the purchase price differential for the benefit of the original holder result in any profit and loss account entry. So again, he's saying that what you're doing here is looking at a deeming provision which is simply there to clothe a particular economic consequence, event, with the status of a loan relationship interest payment so that you can bring it into the computation. But that doesn't mean you have to ignore the underlying reality which generated the deemed interest in the first place. Paragraph 159, it's a similar effect. This is paragraph 159, he's talking about Mr. Holgate's difficulties, which I showed your lordships this morning, in attempting to produce an accounting treatment which corresponded to Section 97. He said, I can't do it without making some assumptions. Paragraph 159, Special Commissioner, it seems to me that the difficulties encountered by Mr. Holgate in determining the proper accounting approach illustrate the problems of this approach. Without more information about the payment and the loan relationship, Mr. Holgate is stuck and has to make more and more assumptions. If the parent is right, that's DCC in this case, if DCC is right, then Section 97 has done its work very shoddily, for other than the case of the recipient, it's provided no help on how Section 84 should apply. That seems to me to be a reason for supposing it should not apply, as Mr. Gardner has accepted. So, as I say, although I don't go all the way with the Special Commissioner to where he ended up, which is to say that you simply interrogate the statutory accounts and see whether or not there are entries in them which correspond to these loan relationship interest payments or not, we do accept that he got the right, the premise of his argument was correct. That is the right way of looking at these deeming provisions, that they clothe economic events with the status of interest under a loan relationship so that you can bring it into the computation. And that also then parallels the passages your lordships have seen in Lord Justice Moses' judgment, particularly at paragraph 69. Now, there are one or two other points, Lord, that I wanted to pick up on DCC's case and arguments, particularly the arguments that my then friend put yesterday. I don't know, I mean, I'm happy to I can probably do the first one in 5 minutes if the Lordship want me to start that now.
We're obviously going to have to continue to tomorrow morning. Is there a point that you can advance just now and complete before we get to 4 o'clock?
Actually, the first point does go on a little while. We're not going to be very long tomorrow morning, so this might actually be a convenient point to take.
Perhaps it would be neater to stop now.
Yes.
For our own planning tomorrow, because obviously we're not going to have a full day in this courtroom, can you give us some idea of how?
I would not anticipate being more than 30 minutes, subject to any questions that your lordships may have for me, but I would have thought left to my own devices about 30 minutes.
Right, half an hour. Mr. Gardner?
My lord, certainly at the outside, an hour and a half. I would hope only an hour.
Yes. Good. So if we can reckon we should be finished by about midday, that sort of time. Yes. Well, we'll sit again at 10:30.